and welcome to another edition of Nucleus Investment Insights. We are going to have a quick look this week at the NVIDIA and the mainly because it's sort of this bellwether for this AI boom we've been talking about for a little while. And its result last night, the share price was down quite significantly. There is so positive in terms of the actual earnings, negative in terms of the next quarter. Question marks on the future. And so I just thought it well worth sort of jumping in to have a bit of a dig into the numbers a bit closer and just sort of talk about what we're seeing and sort of the preliminary views on it, because it is going to be it's going to be very hard to have a tech boom if NVIDIA isn't leading the way, certainly in the short term. So just a reminder that everything you're going to hear today, none of it is personal advice. It's all general in nature. If you do want us to talk about your personal advice, then book a call and have a chat with us. So I think I thought I'd start back a little bit further and just sort of talk about this main thought around NVIDIA, just to sort of give you that concept of where we're coming from in terms of looking at this analysis, because there's within any company result, there's always this thought about what's happening at the short term, and in particularly in the US, the very short term. What's this quarter's earnings doing? What's next quarter's earnings doing? Versus that longer term view about where the stock's going, and that longer term view is really what's going to drive you into whether you want to be owning these things in the longer term or the shorter term. Traders might be jumping in and out, and ironically, in NVIDIA, I think there's probably a lot of traders on the stock driven by AI in terms of or models that are driven by AI that sort of are going to be pushing this stock around in the short term. But it's really that long-term fundamentals that's going to drive the net effect of it. And so we've spoken before about, and for anyone who hasn't seen this chart, I've just got something up on or listening on the podcast, just showing the improvements in terms of CPUs versus GPUs. And so the difference is the CPU is what you got out of AMD or Intel over the last sort of 20, 30 years. And that was really the workhorse of computation. Very, very good generalist in terms of being able to do lots of different things within your computer. Whereas a GPU, so the CPU is the central processing unit that you get in most computers. The GPU is the graphics processing unit, and that's very good at doing very specific calculations. So calculations that are very good at doing video games on one side. Also very good at doing calculations for some versions of crypto mining. Not Bitcoin, but some other ones. And then in particular, very good at doing AI calculations and very efficient at doing that. Now, the improvements in CPU was pretty linear for a long time. We had this whole idea of Moore's law where over time they'd get faster, and computers got faster and faster every year. And it was this sort of relatively linear improvements that's just faded away over the last couple of years, and it's very much flattened out, and there's some sort of physics issues that are sort of falling into that. Meantime, we've had GPUs sort of really come to the fore, and particularly in terms of the types of calculations that are particularly needing to be done at the moment, and they've sort of taken over from this. So the CPU line is sort of flattened out, but we've got this GPU line that's still on this sort of 45-degree angle in terms of improvements. Now, so that's one part of the equation. The second part of the equation is whether the new unit of compute is actually a data center and not a computer, or certainly not a single chip. So it used to be that the thought was that single chips were the ones that were getting faster and faster every year. And that was what was driving the growth. Whereas the thought now is saying, well, maybe it actually doesn't matter if your chips aren't getting faster every year. If your data center is getting faster every year, then you're still getting those improvements, or the grouping together of a bunch of chips together if they're getting faster every year. And that's where you come through to the NVIDIA story, because I've sort of titled this slide is it a role player or a superstar? And it's probably more important on the next one, because there's two ways of looking at NVIDIA. NVIDIA, one way is saying they're a company that's got lucky a couple of times. They were very good at graphics chips, and that was sort of their reason for being. And then it happened to be that that a number of these graphics chips were very efficient at doing crypto mining, and not for Bitcoin, but very much for Ethereum. And so we had this massive boom in NVIDIA as it took off, as everyone started buying chips for to run their crypto mining. And then Ethereum went to proof of work rather than proof of stake rather than proof of work. And so the amount of computing needed suddenly fell by 99 point something percent, and NVIDIA sort of crashed back down. So they sort of got lucky in that they were in the right place with a product that these people wanted. And then we had this AI boom, and so there's an argument that, hey, they just got lucky again. They happen to be very good at doing these calculations and very efficient, and that they're at the front of the curve, and so they just happen to be in the right spot and sort of picking up from that. And so and if your view is that NVIDIA is just one small part of these data centers, and that they're just a bit player, sort of more similar to sort of a Cisco or something like that in the internet boom, then the thing's in a bubble. It's overpriced relative to what you'd see within any of these guys. It's got sort of 90-something% market share. Eventually, that'll come back. Who knows if it's 5 years' time or 10 years' time or 20 years' time. But chip companies generally don't last forever in terms of their competitive advantage. You've got to keep coming up with something every year. It's a really nasty industry. You've got to spend a lot of money on CapEx. You've always got to stay at the front, and nobody cares that Intel used to be the best. They're not buying their products anymore, and if they're not the fastest chip that's out there. And so, if that's your view, is that they're just a role player, then it's clearly in a bubble. The question is whether it's a superstar, and it's in this, it's actually leading the charge in terms of how data centers are going to be put together. Now, there's three ways. I've got a slide up just for anyone listening in on the podcast. A slide up just sort of showing the three different components for sort of passing data around, or three of the components. And one of them is this Ethernet part, which is, think about this as servers talking to each other in a data center. And so, the bandwidth you sort of get in terabytes per second is about 0.8. You can sort of go a couple of 100 meters that way, and they're quite expensive from a power perspective. And they're in terms of the amount of power versus the cost effectiveness, it's relatively expensive. The next step is saying, is this NVLink, which is NVIDIA's sort of setup, which is the GPUs talking to each other. So it's basically getting them in much closer to each other and having the GPUs communicate with each other. And the reason why this is very useful is because the types of calculations that are being done in artificial intelligence need masses of data, whereas the types of calculations you were doing sort of 5 years or 10 years ago, or even types of calculations you're doing for most tasks, most other sort of non-AI tasks, can be done in sort of very small components and then passed back. So you sort of go and do this calculation for me and give me back the answers, and then another one go do the and then compile all the answers together, and off we go. Whereas a lot of the AI ones, it's really about sort of joining those together and actually holding sort of masses of information in memory and then running the calculations on that. So what NVIDIA is quite good at doing is getting these GPUs to talk to each other, and they've got this NVLink, which is sort of driving that, and that sort of works over about a meter and a half. So you need them all within the same server or within very close distance, and they're much more power efficient. And from a cost perspective, they're a factor 10 times more cost effective than sort of running things over Ethernet. And then the other one is this HBM3, which is, and think about this as sort of saying, if you've got a graphics processing unit itself, and you want it to talk to other components like the memory and other bits, and other components that you're going to need in terms of the computation, particularly the memory, is that there's these bottlenecks that you get in the traditional architecture. And so what NVIDIA's been good at doing is they've got this sort of way of stacking the memory and integrating it with the GPU, which sort of turns that bandwidth again into much, much higher. Now, this only works over very small distances. So it's talking about having these sort of integrated into the chip. And, the cost per gigabit, turns into almost free from a perspective of how you're running these calculations. And so that's where, you can pick up a lot of these power savings. And so the idea is, if you're looking at a data center and saying the fundamental way a data center is put together is going to change, it's no longer going to be these independent servers sort of sitting within a data center, which may be talking to each other. They may be talking to, company operations halfway around the world and passing things back and forth. If it's more about saying, no, the fundamental design now needs to turn around to be GPU based. It needs to be all about how do you get these things stacked together, talking with the memory much faster, and then about how do you get those GPUs talking to each other and sharing these masses of data, and then firing out the answer. Then NVIDIA looks like a superstar. It looks like it's a long way in front of everyone else in terms of both the thinking about this and the design and how they're putting them together. Now, are they right? And that's the sort of key question to this. And it is very hard to tell. So there is a strong possibility they're right, but there's also a possibility that somebody else will pop up with something better or faster or simpler or whatever it is over a period of time, and they won't sort of keep that advantage for a long period of time. So that's sort of the key question where, for me, I'm always trying to answer whenever I'm looking at NVIDIA numbers, because what we're seeing from NVIDIA is that what we're seeing from NVIDIA in terms of their earnings is that it's small movements now that we're trying to extrapolate out into years and years in the future and say, what's going to happen in terms of that those numbers. So I'll jump back to I'll jump back to some of these thoughts around the actual result now, which is sort of more important for what we're for what we're talking about. So second quarter was great. Beat on the revenue lines, beat on the profit lines, all fine. It's probably not as didn't beat by as much as it has been in recent periods, but it's a beat. Like it's significant. Numbers came in significantly higher than what analysts were forecasting. So that's sort of one side. Now the stock's fallen a lot. Now why has it fallen? The third quarter is going to be weak in terms of growth. It's still got growth, but it's not going to be the same type of growth we've seen, and most of that's behind this. These delays they're getting within these Blackwell chips, and these Blackwell chips is the next iteration of chips that are coming out, significantly more power efficient and significantly faster and by factor over all the existing ones. Now, it's in a way. So the question comes back to saying, well, is this a fundamental? Is this an indication that they're falling back and they're sort of not efficient in terms of it's not as efficient in terms of the rollout? Is it a sign that they're going to go from 90-something% market share that's going to fall back to less of a share, to 80, 70, 60% share? Probably not. It's hard to see these numbers and the sort of the delays as being anything other than they're selling an extraordinary amount of these things. The growth is extraordinary. They're working with TSMC in terms of setting these productions, and we're talking about doubling in terms of the production lines over periods of sort of 3 and 6 months in terms of the amount of these things being produced. So I think in terms of that side, yes, it's not as strong as what was expected, but it's clear that there's not a competitor sort of that's going to jump in and start taking away market share. So, very much the indications we get from everywhere are that, their existing chip lines are the best they're out there and the most efficient, and on a cost basis sort of certainly adds up for companies doing it. The new ones will be even better, but there's no, the fact that the new ones might be delayed another month or two, there's no sort of there's no other manufacturer out there that's going to slip in and start taking away market share. So there is this extrapolation issue, though. Is this the initial signs that they can't handle the growth? So that's one answer. Probably not, but it might be. The second part within that is then saying, in terms of the extrapolation, is then saying, well, what are we seeing in terms of orders? Are we seeing orders starting to fall off? So are we starting to see that the big players starting to say that they're spending probably $300 billion this year in terms of capital expenditure on data centers? Are they actually saying, no, that's too much, we've got to start winding it back? And the answer's been, again, no. That for the most part, all the big players are investing as much as they can, and it's more capacity constrained rather constrained in terms of getting access to data centers and chips and power and all these other factors they want to do in terms of it. That's been the limiting factor more so than the returns and concern over the returns. So from that perspective, I think the demand side, we're not seeing any sort of particular weakness in that. And I'd also I guess highlight that one of the areas of demand that might there certainly looks to be coming through at the moment in initial stages, but really isn't massive yet, is government demand, and that could be significant, and it could be relatively price insensitive. Let's call it as well. So we've got a whole bunch of countries out there, places from Saudi Arabia to Malaysia to Russia, China, a whole bunch of other countries that are trying to set up their own models within these. Now, there's limitations in terms of China, but when you hear about countries like Malaysia trying to set up their own country-specific large language models, or Saudi Arabia, they're going to be spending money. It's going to be out there on chips. For some of these countries, it's about trying to control their population in a particular way, and so it's not going to be I guess price isn't going to be a major determining factor in terms of, and certainly not price in terms of a few $billion here or a few $1 billion there in terms of do I go with the second best or the third best version of this rather than the best version. So demand, still seems to be relatively strong, and that sort of leads us all the way back to what the key part of this, which is the valuation side, and where are these numbers going in the longer term. So the question on this side is saying, actually, I might come back to that in just a sec.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. So before we get to the valuations, actually, what I did want to talk about a little bit was just the fundamentals about the earnings that we're looking at from NVIDIA. So at the moment, they're 2024, and having said that, they report to a January year end, so it's a bit weird. So it's really the 2023 earnings with 1 month of 2024. So in 2023 earnings, or calendar 2023 earnings was roughly 32 billion on 61 billion worth of sales was what we're looking at. So then we're going through to 20. So that was the actual. Now we're looking at 2025. Now we've got half of the years in the bank already. And so we're looking at the next half. So we've got sort of this partial forecast where we're looking at roughly $70 billion worth of revenue on $121 billion worth of sales. So that ratio, I guess, of ending up with a profit of sort of roughly or a bit more than half. So the margins are very, very good. There's a question mark over that as well. So where does that go from there? So in terms of forecast, so the 2020, let's call it calendar 2025 plus a month. It's forecast to be 95 billion on 170. So you're looking at sales growing by a bit less than 50%, and revenues growing by sort of 40%, close to 50% as well. So sorry, no, more like 40% in terms of your profits. So not huge in terms of the size. I guess that largely matches, I guess, with what we'd see from forecasts from the data centers and how much they're looking to be spending. It actually is implying a bit of a lower margin, and a bit that NVIDIA will be capturing a bit less of the total market. And then that's sort of going from there for the calendar 2026 forecast to $108 billion, which is sort of about a bit less than 20% growth. A bit less than 15% growth on the 2026 number, and then on 193 billion worth of sales. And again, that's only sort of 15% growth in terms of sales at that point. So the numbers are they're significant, but in terms of that growth number, but I guess in terms of saying, could you see a market where in 2 years' time, the amount of capital expenditure being spent on data centers and in particular GPUs going to NVIDIA is a little bit more than 50% higher than what it is today. And that seems like eminently reasonable. We're not talking about sort of 10 times sales or anything like that. It's a much slower growth rate from here. So around that, there are some questions around margins that are going to have to be raised. So and I guess what I'm alluding to there is NVIDIA gets excellent margins in terms of their chips at the moment, much higher than what you've seen in the past. And a lot of that is a sort of demand supply issue, is that we're looking at data centers wanting to build as fast as possible, and these hyperscale capex wanting to build as fast as possible on the back of just not really having the supply out there. And so there's definitely a premium in that. So you can certainly see some weakness in terms of that, the margins that could be coming through over that time period if the production lines are producing a lot faster and coming out. On the flip side, there is potential upside in terms of the sales numbers, I would think, in terms of saying, look, does this end up being something where, countries around the world and militaries in particular feel as if they need to be spending, billions of dollars on getting their data centers up and running and running tests and trying to work out the next version of whether it's drones or missiles or whatever it is that's going to be run from an artificial intelligence point of view. So I think there's there's some downside in terms of margins that I could see within that, but on the flip side, there's upside you could see in terms of revenue, depending upon how that sort of fits together. That's sort of I guess your big picture numbers around that. Where do you skew? And then the final part is the valuation side of it. So on that 2027 forecast, that puts it on about 27 times earnings. Now, if you are just a chip player, that's pretty pricey for a chip player, especially if you thought it was going to go to sort of more normal growth figures from there. So typically, the chip manufacturers would be at a discount to the market. As I spoke before, it's not a very nice sector. You just see the biggest players in that, go from being the biggest players to being also rans within a 5 or 10 year period. As Warren Buffett talks about this idea of this economic moat. These guys, right now, NVIDIA has a pretty big moat, but they've got to keep filling it every few years because, if you don't keep spending that money on CapEx and you don't keep coming up with the latest and greatest, then, then you can fall behind. And so the question is, do they have a 10-year run at this? I'd think so. But that could you have another player appear from somewhere with some new technology, a new way of doing things that nobody ever thought of? Absolutely, that's always a possibility within this sector, and that's why they tend to trade on lower multiples. And you do see some really significant swings in profitability in this sector as well. So right now, these guys are wildly profitable. Typically the biggest players within this sector, even your number ones, when something like an Intel, when it's number one, when it was number one, sort of 15, 20 years ago, would have 40-50% swings in sales, also not sales, in profitability, sort of year to year. And within more component parts, something like say in memory is a good example. Something like a Micron is one of the top 3 memory providers out there, and quite frequently swings from profits to losses, from profits to losses. Within a sort of I don't know, 3 or 4 year period, go through these big cycles. So earnings are really volatile. You don't want to pay heaps for these companies. So with that basis, if I'm buying this thing on 25 times, 27 times earnings, it's relatively expensive. If I think the earnings forecasts are right, if I think there's upside to them, then you can easily come up with scenarios where rather than data centers growing at 20% for the next into the 2026, into the 2025 calendar year, if they grew by that, and then the same again in the following year, then all of a sudden, you can come up with numbers for these guys that might bring it back to 20 times earnings or below. So certainly lots of earnings variability within this. I think the key at the moment, look, NVIDIA's a bit expensive. We're not buying more of it within our portfolios, but we're certainly considering it as if this pullback gets any deeper, we'll probably start topping up. I think there's certainly some thoughts around, do you want to be out of the biggest player in the market, and is this going to be the sort of central driver for the AI boom? And I think the answer is the first answer is, look, you want to be pretty certain you've got it right on the first one. So if you do think it's just a bit player, and you do think it's just one component in the overall factor, then then you probably don't want to own it. And these earnings numbers are way too high. You're going to see margins probably halve from where they are, and maybe sales will go where they might be similar, but on half the margins. So they'll be selling twice as much, but at a much lower cost. If all you think is they're a component player. If you think these guys are actually at the forefront and they're the ones designing these data centers, and they're going to be, you can't build a data center without getting without using the design and the processes sort of around these GPUs that NVIDIA is developing, then there's a reasonable argument that the numbers should be higher. So we're sort of sitting in the part where, look, we think there's a reasonable chance that they are going to be part of this whole data center ecosystem, but we're not sort of all in on it as a process. So we're buying it. We're a little bit overweight at current prices. Looking at the fallback we've had, we'll probably start looking at picking up some more, but it's not a at 20% lower than where it is. Yeah, look, we're starting to pile in at that point. So I think there's enough upside you can see within that. But the other step is that from here, every bit of news people are taking are being extrapolated out for years and years and years into the future. So we're getting these sort of short-term movements that are then sort of extending out. Third quarter is going to be weak. So I think there is potential for it to be relatively weak for the next 3 to 6 months in terms of price, and we'll be looking upon that as an opportunity to sort of get set, subject to nothing changing in our view about the longer term outlook for it. But yeah, very much, I guess we're looking upon this reporting season as being, one, as a validation of the prior effects, 2 is a confirmation. Yes, we sort of already knew there were going to be delays. We've got some more numbers around the delays, and I guess certainly a feature that the third quarter is going to be weak, but that's not really that's not really a sign, or certainly not a solid sign on what it's going to look like over the next sort of 5 years or 10 years. I don't think there's been anything that came out in the result that really dents that, unless you're of the view that, look, TSMC and NVIDIA can't handle the growth, and that's what's going to cause, that's what's causing these problems, and they're just going to get worse. I think that's it's possible, but I think that's unlikely. That seems but both companies have managed to grow really quickly over the last sort of 12 to 18 months in terms of doubling and tripling sales, and I think a slight delay in terms of the new chip release is nothing to be too concerned about just yet, unless we see that continue on. Anyway, with that aside, I will sort of wrap up from here. I think it's worth noting that we are going to be we're going to be talking next week. We sort of delayed the topic, so sorry about that for anyone who was really looking forward to that. Was the idea that there's this flood of capital out there at the moment, so we've got a lot of excess capital, and there's some arguments about what that does and it doesn't do for longer term growth rates and your overall asset allocation and what you should be buying or selling over the next few years. So if you're looking forward to that, we're back on at 12:30 next week, really talking about that, and that's this a much longer term view about what you should be doing with your capital. Should you be investing in the stock market? Should you be investing in property, cash, bonds, whatever it is? In the face of saying we're living in a world of excess capital, what does that mean in terms of your investments, and where should you be looking to invest? All that next week, 12:30 Sydney/Melbourne time. If you want to see anything more, you can grab us on all the major and minor podcast platforms. You can get us on YouTube, or go to nucleuswealth.com/content. Thanks, everyone. Oh, sorry. Actually, and I've got a quick last minute one from Dale. Sorry, I missed that. It was just, when do you think AI will replace my job? Look, it's certainly replacing jobs in the investment markets. AI itself is not particularly well suited to investments at the moment from everything I've seen. And I've sort of been working on models, I don't know, maybe 10, 15 years of models for AI. And the problem they have in the investment markets is they generally tend to overfit. And so what they're doing is they're very good at telling you what you should have done, not particularly good at telling you what you should do going forward. And they do tend to be very good at, so I think there is the place that's most likely to be replacing, or where AI is most likely to be replacing in the short term, is really tasks that have an answer, or either have a very specific answer that could be sort of proven. So, is this a picture of a cat? Is this a picture of a pedestrian walking? Is this a stop sign? Those types of things that can be, or doing a manufacturing process. And they're also very good at coming up with sort of the things that don't really have an answer in terms of marketing strategies, and or certainly putting words around marketing strategies, or putting words around compliance tasks and things like that, and extending out sort of documentation. I think there's sort of certainly big pickups there, but it's hard to see where AI is going to replace the deeper thought ones for a while yet. Yes. Anyway, we'll leave it at that, and we'll see everyone next week. Thanks.